Hey guys, what is happening and welcome to today's video. So today we're talking about a subscriber question, which was like, if I think today and what's happening right now is akin to the 1970s. So we're going to dig into this discussion. So anyway guys, before we get started here, if you like this content, then please make sure you hit that like button because it helps the YouTube algorithm publish the video in more different places. And anyway guys, without further ado, let's do this. Alright guys, welcome back. So, that is an excellent question about whether I think now is like akin to the 1970s. And the thing is, to a point, I think yes, but I think it's a lot worse than the 1970s, to be totally honest with you. In the 1970s, we had at least decent wage growth. We've never had wage growth falling this far away. And I'm talking about real wage growth. So that means wages adjusted for inflation. Because when you take that measly 2 or 3% raise that you got, if you even got that, because I actually did a poll which I'll publish right now on the screen so you can see it, and you can see that most people said that they got 0% pay rise. So if you got 0% pay rise, you just lost around 7% according to the government. But let's face it guys, let's be honest with one another here and say it's not 6-7%, it's not even 8-9-10%. It is more like 17, 18, 19, 20% inflation right now. So with that sort of declines in the purchasing power of people in the real economy, that is bad news. That is worse news, so much worse than the 1970s and the inflation. If you actually look back historically and look at the shadow stats, inflation data on what's actually going on right now posted by John Williams, you'll actually see that inflation, if you measure it in the 1980s index, we are talking about post Second World War levels of inflation, when we had massive supply shocks as people came back from the war and factories had to be converted back to making products instead of tanks and planes and all of these different things. And we're literally having that type of level of inflation, and we just do not have the wage growth right now to back that up. Like, if we had decent wage growth that was just flat, even not even positive in real terms, just flat, then that would be okay. But the fact is, most Western countries since 2008 have had stagnating wages in real terms. Now in nominal terms, it looks like wages are going up, but in real terms, after inflation, wages are going down. And when we think about how manipulated the CPI is right now, you don't have to be a rocket scientist to work out it's a lot worse than they're telling us. But here's the thing guys, it doesn't matter what the government says, whether they say the number is 2%, 5%, 7%. We pay the actual rate. So if the rate is 20% and we're paying 20%, that's 20% less money, that's 20% less purchasing power that we have, that we're losing to inflation. And when you talk about that substantial decline in purchasing power that quickly, you're talking depressionary levels of decline. Now the thing is, we're at the very start of a cycle of recessions or depressions, whichever one you want to call it, but we are at the very start of that, and we've got all the hallmarks of a recession coming to head, because we've got high asset prices, high energy prices, high inflation, the yield curve's inverted, euro-dollar futures curve is inverted. There are many things which give us a high degree of probability to whether a recession is going to occur or not occur, and those are telling us and flashing red saying a recession is coming. And a lot of people say to me, what should I invest in, Luke? What should I do with my money? How do I really navigate this thing? And I'm not an investment advisor. I can't tell you what to do with your money. So unfortunately, that's one thing you're going to have to figure out by yourself. But to be totally honest with you, me personally, I don't feel like there's many good investments right now, many good things that I'm looking at and going, yeah, I'm going to put my money in that, like as a long-term investment. Me personally, I think you've got to have hedges against inflation, but you've also got to have hedges against deflation, because there is risk of both. Because if we do enter a depression, that will be deflationary for asset prices in particular, like stocks and real estate and many other different things. So you have to think very differently to people have thought over the past sort of 20, 30 years. Like, it's a different environment. And the stock market has just had the worst 4-month start to the year since the Great Depression. And that is really eerie to have that out there, because that is bad, guys. Just think about that. Worse than 2008, worse than the dot-com crash. Like, this is big. And the thing is, these things are not going to change. People are getting absolutely decimated. And when you adjust these things for inflation, that everything is losing track with inflation. Like, you really think that things are going to rise with inflation? It's not going to happen. Things like homes, for instance, are not going to rise with inflation. They're underpinned by credit availability, which is underpinned by wage growth. And if wage growth is negative, then how can that happen? Like, if it is happening, then you've got a problem, and we have got a big problem. We've got a highly inflated bubble in the real estate market here in Canada, and in lots of other markets around the world, like New Zealand. Others we've discussed, like the United States, are also in bubbles. So the thing is, you've really got to look at things differently, and you've really just got to, in my opinion, be very prudent with what you're doing with your money right now. Like, it's not a time to just go out and YOLO all your money into one different crypto, into gold or silver, into ETFs, into anything like that. I think the one thing that I can answer that question with is just diversification. And I've said this before, diversification, it saves your behinds when you least expect it. The thing is, guys, obviously the time that we're in right now with inflation is really, really bad. It's worse than the 1970s. Now, we're yet to see the effect of that reflected in unemployment, but don't you worry, that's going to come. And I say that with a heavy heart, because people losing their jobs, people losing their homes, people losing their livelihoods is not a thing that I actually wish for. I mean, people who would think such a thing that I would actually wish for that are out to lunch, in my opinion, because I don't wish for that. That's not something I wish for at all. And I'm not sat here, hoping the market crashes, the real estate market, so I can buy, because as you guys know, I don't want to buy a house here in Canada, and we're going to be leaving Canada over the next few years. Once we get our citizenship, we're going to leave Canada, and that's something that we've decided. Canada was an okay place for the past 5 years, but it's really just gone downhill since we've moved here. And to be totally honest with you, there are just so many better countries out there, so many better opportunities of places to go work or even go travel, whatever floats your boat. And the thing is, over the next couple of years, I just believe that really there's going to be a point where you're going to want to leave these countries, because they're going to be getting seriously gnarly with unemployment, crime, all these different things that are going to happen as the result of the disaster, which is these asset bubbles and the policy mistakes made by central bankers and central planners. And the thing is, we're not out of the woods even with these policy mistakes. Like, they could certainly make more in the future, like if they drop rates. Like, a lot of people think if a recession hits, Luke, they will drop rates and everything will be fine and it will be all good. If they drop rates into rising inflation, that could be the worst thing that they could possibly do. Not only will that send you into a depression, but you could possibly get hyperinflation. And we're seeing that currencies are really under pressure. Like, there's really currency wars that are starting to break out right now. And that's a bad sign, because often currency wars turn into actual wars, and really that's not something that we want. And the thing is, guys, I wouldn't wish for that if I was you. The best case scenario, I think, is a deflationary recession / depression, which would probably last at least a decade. I mean, let's face it, guys, since 2008, the recession has lasted over a decade, because if you look at wage stagnation, it hasn't grown. Like, the only thing that has gone down are interest rates in order to give people extra purchasing power. And this is why it's such a Ponzi economy, because it can't last that way. And now you've got the reversal of all those different policies, and people just can't see the writing on the wall, or they refuse to see the writing on the wall because, you know, they might have bought into these asset bubbles and benefited from these asset bubbles in lots of different ways, and that's how they've achieved some wealth. Even though that wealth has been fake, it's been built on the bubble economy, it hasn't been real, it's been built on credit. They just don't realize it yet. And the same thing happened in 2008, guys. I hate to break it to you. You know, you can relate a lot of times in the past, all these asset bubbles where there has been fake wealth that has been created out of the asset bubbles. And unfortunately, that extends to even companies that renovate people's basement. I mean, think about it, guys. Who is going to be renovating their basement, renovating their kitchen, when their house price is going down by 10-20% per year? Nobody is going to be doing that. And people find the cash to finance things like that through using home equity lines of credit, because they think, hey, I might as well take this equity out, I'll just pay the interest on it, it's such a small portion because my house price is never going to go down. And really, they don't realize the risk involved with taking on these lines of credit and these different products, and they don't really understand what they're getting into, and that leaves them highly vulnerable to losing their home in the future. Even if they have a massive amount of home equity, that really doesn't matter if they don't have a massive amount of collateral, pristine collateral, which is liquidity, it's cash, it's no strings attached cash. Then those people may be screwed. They may get a margin call in the future. And the banks, they don't care. They don't care about me. They don't care about you. They will throw you under the bus at any time they can just to get their bonuses. And just realize that the bank isn't your friend. A lot of people think the banks are their friend here in Canada, and I'm here to tell you, they are not your friend. They will throw you under the bus at any minute, and you will end up cursing those same banks. So anyway, guys, thank you so much for watching. If you enjoyed this video, please hit that like button. If you didn't enjoy this video, you're welcome to hit that dislike button too, even though YouTube doesn't even show the dislikes anymore. And anyway, guys, I'll see you in the next one. Peace as always. Bye-bye.